Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, the Director of Investor Education here at PassiveInvesting.com. And with us today, we have a special guest, Aaron Fragnito. Aaron, welcome to the podcast.
Thank you, Whitney. I'm very glad to be here.
Excellent. Well, before we dive into the details of Bayonne Holdings, which is a 20-unit apartment building in Bayonne, New Jersey, tell us a little bit about yourself and how you got into multifamily investing and where you're at today.
Sure. So I was graduating college in 2009, and it was a pretty dismal market to be graduating into, arguably the worst job market in probably 70 years. So I read a book called Rich Dad, Poor Dad. And of course, like many other guests on your show, I'm sure I was inspired to become a real estate millionaire and start buying more books about how to do that, how to create a real estate syndication. David Lindahl, Trump University, and they all explain how easy it is to just raise some capital, hire a management company, find an apartment building, and bada bing, bada boom, you got yourself an apartment building syndication. So knowing how easy it was after reading those books, the logical next step was to go out and start a real estate syndication. Well, Whitney, surprise, surprise, those books made it seem a bit easier than it actually is. It's actually very difficult to start a real estate fund. So I made a list. I said, okay, in 10 years, I want to have a net worth of $1 million. I want to have $100,000 of passive income. And to get there, I need to make connections, learn the business, make some money, figure out how this works. And okay, I'm going to start as a realtor. I'm going to get my license. So at the time I graduated from college, I actually moved out to Steamboat Springs to teach kids how to ski for 6 months. But I moved back to Jersey. I said, okay, I'm going to get my real estate license. I'm going to learn how to be a realtor. So I did that. I learned short sales. I learned foreclosures. It was a dismal market. I made $500 my first 6 months as a realtor. It took me about 3 years to really start making some dough. And then I finally made six figures, and I owed the tax man like 40 grand at the end of April. I didn't have it. I was like 25. I was like, wow, I read Rich Dad, Poor Dad. I know my passion in this business is to build wealth through ownership of real estate, to pay myself through the refinance of quality assets, and pay myself tax-free. I know how to do that. I read the book on it. I'm just not doing it. Instead, I'm creating a high income here that's highly taxed. I live in Hoboken, New Jersey in a nice condo, and I drive an Audi. I developed a lifestyle where my liabilities were equal or greater than my assets, and I really had no assets, and I was just working for my money. So I reset, sold the Audi, got a Hyundai, moved back home with my parents, and I'm going to do this the right way. I consciously transitioned my company from being a realtor into being a real estate investor, and convincing and working with a lot of those people I was working with, and instead of them investing in deals and investing with me, and we would invest together on properties. I met my business partner, Seth Martinez, around 2011 or so, in kind of the midst of this, and we bought a property in 2012, renovated it, refinanced our money back out. We said, hey, this makes sense. And we started teaming up on more properties, and we incorporated People's Capital Group in 2013 to help people invest in New Jersey apartment buildings. And we developed our management company in 2015, PCG Property Management. So Seth and I today, we've done over 300 transactions together. We've fixed and flipped over 50 properties. We've wholesaled another 100 or so. We've done 9 real estate syndications, and we've really practiced to develop the art of taking a mismanaged apartment building, transitioning it into a nice cash flowing asset for our investors, and completing a cash out refinance over time to get our investors a big lump sum. So about $25 million portfolio today, about 150 doors, and around 100 private investors in our group. Yeah.
Awesome. Well, let's dive into the details of Bayonne Holdings, this 21 unit property in Bayonne, New Jersey, because I am sure that you have tons of experience to share with us, just given your track record. We were talking before the show, you just closed this a couple of weeks ago. So really recent, where we're going to get a sneak peek into the market here on what things are really looking like today. But let's back it up. So you closed it in February. You paid $4 million for it, right?
3.9.
3.9. Okay. So how did you find the deal?
So we work with realtors very closely. We tell them exactly what we're looking for and to call us first when they have it. This realtor did that. I think he maybe called a few other buyers, but he called us first. He said, here's the deal, family owned for 40 years, rents 35% below market value, great location, 3 blocks of the water, near a light rail station, hot market. Here's the number. We hemmed and we hawed. We tried to get it for less. We realized if it went on the market, it's going to go for more. We said, okay, let's move on it. It's a great opportunity. So we put up an offer within 24 hours and put it under contract pretty quickly.
You didn't have it on too long. Okay, so when did you get that call though? Was it?
I mean, it was a little while ago. The bank was very slow to close. We used a very small local bank, and they gave us a great rate and terms, but they were very slow to close. They were very understaffed, they kept saying. So it took about 3 months to close out the loan. So I think we initially went under contract in like October or something.
Okay, so you get the call sometime in October. You sit on it for only 24 hours. So did you put in a letter of intent at that point in time, or did you just go ahead and draft up a PSA?
No, we went with the letter of intent, of course, and we got a signed letter of intent. We put a pretty quick timeline on it. That's a good trick for LOIs to say, hey, you have 48 hours or 24 hours to accept my LOI, not go shop it around to everyone else, right? So we also gave them what they wanted. We hemmed and we hawed a little bit, but we eventually said, okay, the number works. We'll give them the number.
So what was that timeline? What did you put in that LOI? How did you seal the deal, knowing that your broker was calling other invested parties?
He wasn't supposed to be calling other brokers. I'm sure he's calling everyone that's going down his whole phone,
trying to close one more before the end of the year, right?
No, I mean, that's the whole idea. You got to have good relationships with brokers, just like you do landlords and investors. So we treat everyone we do business with, whether it's a real estate broker selling us $1 million properties, or a Section 8 tenant, or a contractor, doing a small or big project for us. We treat everyone with our best foot forward. So, I mean, he knew that we are the real deal. He told, it's funny, I spoke with the seller the day of closing. We did a building walkthrough. We had a very candid conversation, right? You finally get to the closing, and sometimes you get a chance to talk to the seller one-on-one with no brokers, no attorneys, no other people. It's just me and him in the basement of the property. And he's telling me all the other offers that were on the table, which made me feel better. Telling me how the broker kind of talked us up, and that's why I went with our offers. So, and that's exactly what the broker's job is. So no, overall, we gave them the number they wanted. We got the LOI signed quickly. I think there was a 48-hour period they had to respond in, or something like that.
And what was the timeline, right? Like due diligence timeline, closing timeline. Were there any extensions involved?
So I think our due diligence was required to be done before getting the contract signed. So the due diligence period was, that welcome to New Jersey real estate. When you want to buy a deal in the hot market in New Jersey, New York, you often, at least recently, have had to take that due diligence period and throw it in the trash. All right. Now, we still have an environmental due diligence, right? So, and there actually was an environmental issue that we ended up kind of working out with them. But I think our due diligence period was really between LOI to going under contract. And once the purchase contract was drafted and signed and the deposit placed, we were out of our due diligence period, except for environmental, which was 30 days into the contract. And so we had a 30-day window to do the environmental test. Okay.
So tell us so how long was that timeline between, was it 1 week, 2 weeks between LOI to PSA? And then when did you set foot on that property, and who did you bring with you in order to be comfortable in signing the agreement like that?
Sure. So Seth had actually walked through the property. My business partner is in charge of due diligence and operations. So he walked through it, and it was a good asset, in good shape. We looked over the numbers from the realtor, but essentially it was about a 30-day period from LOI to the signing of the purchase contract. Because remember, you both have attorneys, they're back and forth. There was some holidays going on. The broker and I think the sellers were Jewish. There was a number of Jewish holidays in October. So that kind of delayed things. And then just quite frankly, the process of going back and forth, because your LOI is like practically a piece of toilet paper by the end of it. By the time the attorneys get the PSA going, I'm trying not to swear as you told me about it. So, the PSA going, so the attorneys rip it all up. His attorney wants this, we want that, no one agrees on anything. We're like, guys, come on, we have an LOI. So it did take about 30 days to go into contract. Okay. And that's a good thing if you're a buyer trying to do your due diligence before going into contract, right? Because we wanted to do a home inspection of the property. We still had a full inspection of the property. We're still reviewing financials. We're reviewing all the legal documents, reviewing all the documents we need to, the OPA request, other things, to make sure that, the trailing 12 months collections, to make sure we're buying good property, review all the leases. And this allows us to really understand exactly what we're getting into before we go into purchase contract, before we put up that non-refundable deposit. So we still complete all of our due diligence. We just have to do it in that period from LOI to contract, which does tend to be a 2 to 4 week period. And, you can make it 4 weeks here and there. There's, so there's ways to do that. And at the end of the day, you don't want to drag it on too long, because you don't want the seller to get, cold feet or get annoyed at you and go with a different offer, because you're really just in an LOI stage. So there's no legal ramifications for anyone backing out at that point. You might be called a few names, but there's really no legal ramifications backing out in the LOI stage. Once you go into purchase contract and assigning a deposit, then there can be ramifications, especially if there's no due diligence period like we found ourselves in. But so we did our due diligence in that 30-day period. We go under contract, and we did our environmental due diligence and got our mortgage lined up as well at the same time.
So how much money did you have to put down, and when did it go hard?
$150,000 deposit, which is also part of, negotiating, right? You don't want to negotiate a crazy big deposit and be at risk as the buyer, but you don't want to come in too low either and look at like a weak buyer either. So we put up $150,000. By then we've reviewed the leases, we reviewed the collections, we've done a full inspection of the property, but there's some risk there, right? Because we're paying for a $6,000 property inspection before we technically have it under contract. So if the buyer wanted to be a jerk, or the broker, they could go and pull it out from under us, but that'd probably be the last time we do business with that broker or that seller, right? So, but yeah, so that's the process there. And then, yeah.
So when you got this signed, and I want to dig into the due diligence, but just for the timeline to help the listeners understand. So when the PSA was signed, was that when you put up the $150,000, and was it hard, or was it hard like 30 days later after the environmental?
I mean, it's hard.
Or was it ever hard?
Yeah, I mean, it's hard, minus environmental issues, right? So like, let's say, you sign the purchase contract, you put up the $150,000, and your mortgage lender says, sorry, building didn't appraise properly, you can't do it. Or there was a problem with your credit report, you don't qualify for the loan. Or let's say, we find out that there's some type of issue that's not environmental. It could be maybe a structural issue with the property that we for some reason didn't catch in the initial inspection, or some type of engineering issue, which can sometimes be environmental. It's kind of gray, so but yeah, or the leases were not done right or something. That's our problem now. We should have figured that out and found that issue in our due diligence period between LOI to purchase contract. And when you put up that deposit and your only contingency is an environmental contingency, then yeah, you really have limited ways to back out of the contract at that point. You got to make sure you're in it for the long haul.
Awesome. Okay. Thank you for helping us understand the timeline there. Okay. So now we're to the point. We've got a purchase sale agreement signed. We're probably, sounds like early mid-November by this point, just given kind of the back and forth on the LOI. But you've done all of your due diligence except for the environmental. Let's talk about that due diligence. What did you uncover, if anything, between the physical due diligence and the financial due diligence?
Well, it's been family owned for 40 years, right? And they just kind of forgot to raise the rent for the last few years, but we're really good at physically maintaining the property. So there was a true pride of ownership, but maybe a misunderstanding of how to reposition apartment buildings, which is perfect for us, right? So, what we found was they did not have a T12 collection report, so we couldn't look at the last 12 months of rental collections. They could only show us for last month's rental collections, okay? And
were they managing it themselves?
They were managing themselves. They had a family member living in the property, managing the property, and it was well maintained, very well maintained physically, okay? Most of the leases were month-to-month leases. Most of the rents were 25 to 45% below market value. So if someone wasn't paying their rent, it's not really a bad thing for us, because what that allows us to do is file an eviction and evict the tenant from the property. Now, we don't want to do that, but at the end of the day, if someone's not paying rent, that is what you have to do as a landlord. It's a natural market process. So that allows us to have then the unit vacated, so we can renovate the unit and lease it up for top dollar. So it is important that rent's being paid. We don't want every single tenant not paying rent, but it's not really a problem if a few tenants aren't paying rent. So collections are important for your bank and for your investors, and it understands an operator how much excess cash you'll need to cover your operating costs until you get the building stabilized. But a lot of non-paying tenants in a state that's a little not landlord friendly, it's tenant friendly, so it is hard to remove tenants, especially if they're cooperating and everything like that. But a tenant's not paying you rent, well, that's an easy process, right? You can go to eviction court and have the tenant removed. So actually that's not a terrible thing when you have tenants not paying rent. It allows you to then have turnover, renovate those units, lease up for top dollar, and get one step closer to your refinance target or your exit target, right? So
I don't want to lose sight of the environmental thing that, piece that you already alluded to, but I want to help us understand if you have and maybe your economic vacancy, the non-paying tenants, wasn't as great as what I'm thinking it is. When you don't have a trailing 12, you already know that you have all these leases on month to month. How did the underwriting with the bank go in order to secure a loan on this property? Like, what kind of lending did you get to allow you to, because most of the time lenders want to have some sort of stabilization. And it sounds like there was some, but maybe not as much as one would hope for.
Yeah, I mean, it was a rather stabilized property. It started with having one vacancy. By the time we finally closed, there were 4 vacancies, which we said, please leave them vacant, because again, the hardest thing in New Jersey is getting the unit vacant. Once it's vacant, we can renovate it quickly, get it leased up for top dollar. There's a line out the door to lease the thing. The demand for rental space in North Jersey is through the roof. The process of removing tenants is difficult. So this is a more landlord friendly city. So that's one of the reasons we invested here. But yeah, you're absolutely right. When you're buying a property here, you have to appease the bank. They're looking at the leases, they're looking at rent collections. Rent collections were strong, so everyone was paying rent. But just the fact that they're month to month is frustrating. But the bank understands that we're going to put a lot of those tenants on a year-long lease and negotiate it higher, and other tenants we're going to work out an amicable exit and then renovate the unit and lease it up for $500, $600, $700 more per month, which the bank likes as well, right? We also have a great track record. We have a $25 million portfolio. We have 150 doors. We have a 300 plus transactions completed. It's a good asset in a good town. It's in good physical condition. So I think the bank took all of that into account. They're also a small local lender. We went with a New Haven Savings Bank. They're a good lender. We like them, a little slow to close, but very cooperative with us. We're able to kind of look at the overall picture. We have an in-house property management company. We have over 100 private investors. We have a reputation we want to protect. And that allows us to qualify for these loans. Now, if this is a big national bank, there's no way we would get out the mortgage, right? This is a relationship-based bank, small local banks, credit unions. These are the banks we work with. I do not work with national banks. We don't fit in that box.
Mm-hmm. All right. Well, before we go too far down the lending rabbit hole, because I want to come back and understand the terms that you secured there. Talk to us about the environmental piece. So you've done your due diligence, the physical due diligence. You have this environmental piece that's hanging out there. You have your 150,000 down, essentially hard. At this point in time, what happened during the environmental study?
So yeah, there are 2 underground oil tanks initially at the property. Okay, we had them tested, and the soil came back contaminated. So that means the tanks are leaking, which is like the last thing you want, right? So the sellers were pretty quick to install 2 new above ground tanks in the basement, so that the oil boiler could be supplied oil while we remove the tanks. And We plan on converting the building to HVAC anyway, so that oil boiler is kind of on its way out. But what we said to the seller was, well, first we tried to get a huge discount on the property. And they said, no, we're just going to remove the tanks ourselves. And once we're done, you can close on the property. We didn't really like that because it would have taken about 90 days from them to do that. And we were worried that our debt was going to increase. Our interest rate was going to increase on our term sheet, right? So we wanted to close faster. We also had all our capital, our investors ready to go, and you tell your investors, oh, sorry, there's a 3-month delay or something. Some of them might get cold feet. Now you're raising new capital. So we're just like, you know what? Let's just get this thing done. So we didn't want to be too aggressive there because we want to be smart here and protect our investors' interest as well. So we said, okay, we will take the property with the contamination, but first of all, we got multiple quotes in the cleanup. The quotes came in around 20 to 40,000 worst case scenario. So we had the seller escrow 120,000, which was 3 times the worst case scenario, right? So I mean, we just felt like that was a lot of cushion in there. So the $120,000 held in escrow by our attorney, by the way, our attorney holds the money and we get to hold some of the money too. So we kind of worked that out and we get to use our contractors for the project and never mind. So basically, what we can do with this is control the project here, get it done in a timely manner, make sure it's done right. We know the money is there to cover it 3 times the costs. Whatever's left over goes back to the seller. It's his escrow. And we also negotiated $25,000 off the sale price for this inconvenience to do this, right? So we got a discounted price. We were able to close on the property more quickly. We were able to have the seller cover all the costs for that, manage the project ourselves as well with our contractors. And I'll leave that open-ended there. So basically, at the end of the day, we kind of got what we wanted. Did I want more off the price? Absolutely. But it was a good deal. It made sense. It was fair. So we took it.
I think that's a tactic that is well known, right? To use in the closing process, should something come up on physical due diligence or environmental, but we don't actually hear people doing that often. I've had to do it on one of my own closings too, a couple times, where you have the seller escrow some of these repairs, when you can't get the discount that you want. So that's a great tactic to point out to people, to kind of put in your back pocket. It doesn't always work, right? But when it does work, it can be really beautiful to keep things on track. Now,
I love that strategy. Yeah, seller escrow is the way to go. Absolutely.
Yeah. So let's talk about the debt. Oh, well, actually, before we move on to due diligence, did any of this, since you were escrowing the money and the repairs weren't done, did this impact any ability to get insurance? Did that affect your rate at all?
No, actually, it did take a little additional shopping around, disclosures. Same with the bank. We have to disclose all this, of course. We have to follow up with them, make sure it's done in a timely manner, that the cleanup is completed by a licensed firm and everything like that. The tests are sent to the EPA. We get the no further action letter. All this is required to be done in a certain timely manner. The bank's also holding, $54,000, which, by the way, you want to, say, hey, Mr. Seller, I'm not putting up that 54. You're putting up the 54 grand, take it out of the 120. So yeah, so we worked that all out. So we're not getting hit with like a huge escrow closing on our end. But yeah, I mean, this all has to be disclosed to the bank and the insurance company. And there is a process we have to follow through with on now in a timely manner. But for the most part, it's a pretty straightforward process. And insurance, just like debt, something we shop around for. And with the bigger commercial properties, I do find a lot of service providers are more flexible. If this was like a small single family home and the policy was $250,000, they might not be as welcoming to these issues.
So, all right. So you've gotten through the due diligence, you've gotten through the environmental. Now we're on to the closing process. And you already alluded to during this time, you wanted to keep the project on track because you were concerned about interest rates continuing to go up. You had it under contract. You're now closing right at 3.9 million. Walk us through the capital stack here.
Yeah, so 3.925 was the final sale price. We had a mortgage amount of 2.7. They actually ended up giving us more debt than we originally were thinking on the term sheet. So it's pretty interesting. And we had a 6% interest rate, which really isn't terrible for the environment we're in right now. So Ended up putting about 30% down. We raised about 2.2 million at the end of the day. We had $600,000 for repairs, roughly about like 630, something like that. Another 120 in closing costs, 3% acquisition fee, and operating reserves, of course, as well. So all in all, about a $2.2 million raise. And we had just about almost 30 investors participate in the opportunity. We do a 506B, so some were accredited, some were not accredited, sophisticated investors. So kind of the whole spectrum. I've guys with 7 figures with us and people getting started with $30,000,
Very cool. Very cool. So on the debt piece, you had 6%. Was that fixed or floating rate? Was it
Fixed
interest only?
Yeah, interest only for 3 years, fixed for 5 years. Yeah. Mhm.
Okay. And then any prepayment penalties or lockout periods on the debt?
Yeah, they get you for a 5, 4, 3, 2, 1 prepayment. It just, we try to negotiate down. I think we have a 90-day window at the last 5-year period to avoid a prepayment penalty, but I'd like to refinance before then and might just end up paying the fees. So we'll run the numbers when we get there,
Okay. All right. So on the capital raise, how did you structure that with your limited partner investors?
So we do on the equity split, we do a 70-30 split with the investors owning 70% of the fund and People's Capital Group owning 30%. We do a 5 or 7% annualized preferred rate of return, which means our investors get paid first, the net proceeds of the property, the net positive cash flow and the proceeds from the refinance all go to the investors first until they earn a 5 or 7% annualized cash on cash return. That's the preferred rate of return. The more you invest is how you get to that higher preferred rate of return, investment over 100,000. And so that allowed people to choose what class they want to be in. A $30,000 to $99,000 investment got them into the 5% pref. Over 100,000 gets them into the 7% pref. That makes sure our investors get paid first. And then after we cover that preferred rate, we have our equity split. So we put food on our plate after we perform for our investors. We actually didn't charge an AUM for this. So we don't charge an assets under management fee. Now, this was the last time we'll be doing that. In fact, going forward, we are going to be charging an AUM. As you know, as an operator, it's it's much easier to keep the lights on with an AUM going because it is few and far between on these closings, and with the refinance, it takes years to get there. So, but for the most part, we try to keep our fees very, very low. We don't do a disposition fee. We only charged an acquisition fee on this one. We own our own management company here, so we charge a discounted property management fee, about 2/3 what your normal property management company would charge. So we really don't make our profit through fees. We're not a fee-based fund. We're an equity-based fund. And so we get paid after we put food, after we get our investors paid, we can put food on our own plate.
So were there any other IRR hurdles in here or just a straight 70-30?
Yeah, we don't do the IRR hurdles. We find a lot of our investors don't fully understand what the IRR is, and it just kind of confuses people more. So we try to keep it simple. Confusion seems to be a sales killer, as they say.
Yeah. What is it? What's the quote? A confused mind doesn't buy, right? So
Yeah, so like that. Yeah. So, preferred rate of return makes a lot of sense. Cash and cash return makes sense. Start getting IRRs. I know some other funds do that, but right now we're structured more simply than that.
And so what was when you've alluded to the business plan for this particular asset, in that, definitely value add strategy, you can bump to market rents. You're renovating, you might be looking to refinance somewhere between year 3 and year 5. How long are you refinancing and leaving your investors in? Are you cashing them out? Or how long are you looking to hold this property?
Sure. So our structure is different than a lot of real estate syndications we've seen out there. And we purposefully did this because we just don't see many other people doing this. We actually never kick our investors out. They're allowed to invest with us indefinitely. We plan on refinancing these properties every 3 to 5 years. Our target is return about 50% of their initial investment every 3 to 5 years. Each refinance does not dilute their ownership, so they still have full ownership in the property. And investors also get a quarterly cash flow check as well when there's positive cash flows. So at the refinance, investors can exit. They can get back their initial investment, keep the funds earned from the refinance, keep the funds earned from cash flow, and pay capital gains tax on those earnings. So what most of our investors opt to do is keep their principal invested, keep earning the quarterly cash flow, keep earning a big lump sum upon the refinances. Now, eventually down the road, maybe after 3 refinances, maybe year 15 or so, we'll look at possibly doing a 1031 tax deference, trading up into a bigger property, building our investors' wealth exponentially, and deferring all taxes along the way as well. But that's really our strategy, the swap till you drop strategy, never paying the tax man, keeping your principal invested, planting that seed and just growing from there. And a lot of our investors take the big refinance checks and reinvest that in new opportunities and plant another seed. But we'll never kick you out. We'll never get rid of you. You do have exit options along the way. But not a huge fan of selling my real estate either. It's like, why get rid of your cash flow machine, your tax write-off machine? I'm not really in a rush to get rid of them or sell them. I understand from an operator standpoint, there can be a nice payday there and different fees, and I get that. And normally you do very well for your investors. They'll roll it into a next deal. So I understand the benefits of an operator, but I think honestly, a lot of times investors that, you say, hey, we could sell this, get a big cash payout and pay lots of taxes on it, or we could refinance, and you'll end up roughly keeping about the same amount of cash at the end of the day, because you're not going to pay taxes on the refinance, but on the sale you are. So it's not what you make, it's what you keep. So most of our investors say, hey, I'd rather refinance, get back a big lump sum, keep earning cash flow, get refinances in the future instead of getting a big payout and getting hit on taxes. So, there's no right or wrong way to do it. It's just a different strategy than I see a lot of other funds doing.
So if you're looking to hold these more longer term, maybe sell like closer to that 15-year mark, are you performing a cost segregation analysis on the property in order to accelerate any depreciation forward, or are you just taking inline depreciation?
So we go to our investors and we say, do you want us to do a cost segregation study? Even though they're passive investors, we want to get their opinion on it. Most people say, I'd rather not pay for the $9,000 study. I'd rather just get more cash flow this quarter. Sometimes we have investors that say, I have tons of passive gains and I need a bunch of passive tax write-offs. And in that case, we'll try to work with them. Sometimes if they're a larger investor, we'll get them in on a property and do a cost segregation study just for that benefit for them. But I don't need more tax write-offs. We don't pay ourselves a salary here. We pay ourselves the refinance of assets. Our cash flow is very light on North Jersey real estate. It's about equal to the tax depreciation we get from the property. So at the end of the day, I'm not getting taxed on my cash flow. So our investors normally don't need a huge amount of passive tax write-offs, because if they're invested primarily with People's Capital Group, our investments create no additional tax burden as long as they keep their principal invested. Again, the cash flow is written off with tax depreciation. It's a low cash flow asset. And the main payout is the refinance, which is tax-free. So therefore, they really have no additional tax burden in investing with us. So they don't really need a bunch of passive tax write-offs. So do we spend the $9,000 on a cost segregation site? No, we just produce more cash flow that period, but again, we're not set in stone with that. If we have a group of investors that are in different types of passive opportunities and they need a bunch of passive tax write-offs, we'll kind of sit down and have a conversation with them and see what's a good fit.
Awesome. Well, so it really lends itself to a different type of play in an investor's portfolio as an equity play.
Exactly.
So that's awesome. Well, Aaron, thank you so much for your sharing your expertise with us today. Before we wrap up, I have 2 more questions for you, and I'm going to ask them both at the same time. What did you find that was easy during this process? Or what did you think was going to be easy that actually ended up being hard? And what did you think was going to be hard that actually ended up being easy?
Boy, I wish I had a little more time to think about that. I don't know. I mean, I feel like maybe the debt was easier, but then again, my business partner was primarily in charge of it, so he'd tell you that was hard. I'd say maybe raising the capital was a little harder than we thought, because it was in the midst of this crazy. Every talking head out there in the last 6 months has said the world is falling apart. Don't invest in anything, don't do anything, real estate's going to collapse. So we have lots of very satisfied investors, but people are so nervous right now to invest in anything, whether it's the stock market, bonds. So we're really people. I talk to people; they're scared to invest in CDs. I'm like, if CDs are too risky for you, then I don't really know why we're on the phone. But yeah, so no, for the most part, the investment sentiment over the last 6 months, 8 months has been terrible. So working through that as an operator, as a fundraiser has been challenging, but we have a great group of investors that love reinvesting with us. About a third of our capital also comes from referrals from those investors as well. So we just really are always connecting with new people as well. I love connecting with new investors, and so it always kind of comes together in the end, right? And at the end of the day, we were able to raise all the capital very successfully, and close on the property. But maybe the debt was easier just because I wasn't as involved with it.
All right. Well, Aaron, again, thank you so much for your time today. Where can people find out more about you and People's Capital Group?
Sure. So our website, peoplescapitalgroup.com, has tons of information about what we do and how we help people invest in real estate. It has a podcast on there that we have over 130 episodes of, the Passive Cash Flow Podcast. There's webinars on there. I do a webinar almost every single week about how to invest in real estate. I just did how to self-direct your IRA or 401k into real estate last night. I'm doing an update on our PCG apartment building repositions next week. So check those out, our website, peoplescapitalgroup.com. And we also do in-person networking events on the third Tuesday of the month in Somerset, New Jersey at the Jersey Cyclone Brewery. We tend to get 70 to 80 people out of those events. We pack the house, people in and out of the real estate industry. So if you're local to Jersey, check us out on third Tuesday of the night, third Tuesday of the month there. And but it all starts at peoplescapitalgroup.com.
Awesome. Well, Aaron, thank you again for sharing your knowledge and expertise with us here today. We look forward to having you back on future episodes and seeing your additionally closed deals.
Thanks, Whitney. Have a good day.